This is Jody Trana with Chapter 11, Part 1 of Business Finance. Here you can see the three roles of the Business Finance Manager. Capital budgeting is the step of analyzing different investments to determine which one the firm should take. The second is capital structuring. Once we've decided on our capital project, we need to determine how to finance it through debt or equity. And third, working capital management. This is a step that helps us to operate day to day with a good cash flow balance. Our conversation for this class is going to center around the concepts of capital budgeting. When Boeing makes a decision about retiring older models and producing new ones, like they did with the Dreamliner 787, they have to make huge amounts of investments in the development of the new airplane. Think about in the 1970s when Boeing needed to replace the 727 and they developed the 757 and the 767 jets. In order to do this, it cost them $3 billion, which at that time was more than double the total value of stockholders' investments. By 2002, estimated cumulative profits from this investment were approaching $10 billion, and the planes were still selling. By the early 2000s, sales of the 757 had all but dried up, and Boeing put the plane out to pasture in 2004. So this process goes on and on and on for Boeing. Not all capital programs are successful, of course. The Iridium Communications satellite system offered its users instant telephone connections worldwide. It cost $5 billion in an initial investment before it started operations. This was back in 1998. It needed 400,000 subscribers to break even, but it only attracted a small fraction of that number. Iridium defaulted on its debt and filed for bankruptcy the following year. This Iridium system that cost $5 billion was sold a year later for $25 million. Companies can learn a lot from this example. Iridium's decision to invest in its satellite system and Boeing's decision to invest in a new generation of airplanes are both examples of capital budgeting decisions. The success of such decisions is usually judged in terms of value. Good investment projects are worth more than they cost. Adopting such projects increases the value of the firm and therefore the wealth of its shareholders. For example, Boeing's investment produced a stream of cash flows. Remember that cash flows are the source of value. It produced a stream of cash flows that were worth more than its $3 billion outlay. Good investments are largely a search for opportunities where the firm can exploit some competitive advantage over its competitors. Let's take a look at the different kinds of capital investment projects. They're not all like the two that we just learned about, where we are investing in large-scale equipment. There could be some revenue-enhancing investments. That would be just introducing a new product line. It could be cost reduction investments, such as replacing old equipment with more efficient equipment. Could be a mandatory investment that's a result of government mandates, such as investments needed to meet some kind of safety or maybe new environmental regulations. All of these are capital investment projects. You could even have a capital investment project for intangible assets, such as Gillette when they spent around $300 million to advertise the launch of its Mach 3 razor. This was an investment in intangible assets, brand recognition, and acceptance. Traditional manufacturing firms aren't the only ones that make important capital decisions either. For example, Intel continued to top all other chip companies in research and development expenditures. In 2016, they spent $12.7 billion, and they represented 22.4% of the semiconductor sales in that year. Intel accounted for 36% of the top 10 R&D spending companies. So much of their money and their capital investment goes straight to R&D. This investment in future products and product development is crucial to the company's ability to retain its existing customers and to attract new ones. There are many tools to help determine whether a capital budgeting project is good for a company or not. Here's a list of tools that are presented in the chapter. We may discuss many of these tools in class, but I wanted to show you all the tools just so that you would know what there was available. We will probably concentrate on just these particular tools: net present value, profitability index, internal rate of return, payback period, and discounted payback period. The first calculation that we're going to talk about is net present value. Net present value is grounded in the present value process that we've been talking about and calculating for quite some time. We're going to add one more step to it. So the first step is to determine the present value of future cash flows. You know how to do that. The second step is to calculate the net present value. That means to subtract any initial cash outlay that happens in year 0. The first example we're going to look at should feel pretty familiar. Here we're talking about making a purchase. We're considering buying a new copier that would cost $2,000. It would save us $500 every year for 5 years compared to the old copier that we have now. Our discount rate is 6%. Should we buy it? It always helps to start with a timeline. Here you can see the number of years that are involved with this purchase decision, the 5 years. You can also see our discount rate, the interest rate of 6%, and you can see the $500 savings that we expect with the new copier over the old copier for each one of our 5 years. As we know, we need to discount these cash flows back to year 0. When we do that, each one of these amounts discounted back, added together, makes a present value of $2,106.18. But what does that tell us? $2,106.18 is our present value of the savings. But we need to compare that to our initial cash outlay to identify the net present value. The cash outlay also happens at year 0, so if we subtract that, then our net present value is a positive $106.18. Let's look at the Sabre Electronics example. Here we're considering purchasing specialty manufacturing equipment that costs $3 million. The cash flow for years 1 through 5 will save us an uneven amount. The first year is $500,000, the second year is $750,000, the third year is $1,500,000, and years 4 and 5 will be $2 million. If we're to discount all of these future cash flows at a rate of 20%, is this a good investment? From our previous example, you know that we need to discount each one of these cash flows back to year 0, which wouldn't be too difficult since there are only 5 years. But what if there were 50 years and they all had a slightly different payback? This is a very common situation, and we need to know how to calculate net present value with varying cash flow amounts. I love it when Excel has the easy answer for us. Excel has a function called NPV. When we use that formula, we can add our discount rate and our cash flow amounts to determine the net present value. We have to add, or in this case, subtract our initial cash outlay, the $3 million, in order to calculate our net present value. But the NPV function of Excel allows us to discount future cash flows at different rates. So the 500,000, 750,000, 1,500,000, and the 2 millions will all discount back to present value. It assumes that you put in the cash flow for year 1 first, year 2 second, year 3 third, etc. Using the NPV function in Excel, we will find that the present value of all of these cash flows minus the initial cash outlay equals a positive $573,817. In order to make these decisions, we're looking for a positive net present value. Because we already have our discount rate built in, anything above 0 is acceptable. There are a number of ways to solve the problems you'll see in your homework. When using Excel, you have 2 main options. For annuities, you can treat the problem as you have up to this point and calculate the present value of the future cash flow streams using the PV formula. That's because with annuities, your cash flows are all the same. But you can also use the NPV formula. You just have to enter the cash flow amounts separately, even though they are identical. When calculating the rate of return or internal rate of return for an annuity, you can use the rate formula or the IRR formula. When you're calculating the net present value for irregular cash flows, you can't use the PV function or the rate function. You have to use the NPV formula and the IRR. Of course, you can calculate the present value of the future lump sums of each individual cash flow item and then add them all together. Still, it might be a good time for you to switch over and just use the NPV and the IRR functions, but that can be your choice. Whatever makes the most sense to you. Here's what my Excel template looked like to calculate the previous answer. Notice that calculating the net present value is a 2-step process using Excel. In cell B10, the answer there is $3,573,817. That is the present value of our 5 cash inflows. We need to subtract the $3 million from our present value separately. So that's what we have in B11. B11 is our net present value from B10 minus the $3 million initial cash outlay. Here you can see an example of an Excel template where we're calculating the net present value in 2 different ways. Option number 1 uses the present value function just like we've been using throughout the course. And then we subtract the initial cash outlay from that number. This only works if you have regular annual or regular period numbers that are exactly the same. Here you can see we have $2 million that happens over a number of 6 periods. You can't use option number 1 if you have different cash flows like we did with our Sabre Electronics example. Option number 2 is using the net present value function that we just learned, the NPV function. Using that, you would enter in the $2 million 6 times in order to calculate the present value of that cash flow, and then you would subtract the $8 million initial cash outlay. Either way that you do it, you need to know that in Excel, calculating the net present value is a 2-step process. You first calculate the present value of the future cash flow streams, and then you subtract the initial cash outlay in order to determine the net present value.